Today we're going to look at the second half of section 11.2. This is the more technical, more minutiae side of the section on reconciling the bank statement. Now remember that Roadrunner was charged an $8 bank service fee, and we realized that since that's a business transaction, that's going to need to be journalized, and it's going to need to be posted to the ledger. So let's figure out where the debit and the credit are. Well, any bank service charge is an expense, and we know that expenses are debited. We'll cross the bridge of exactly what account that is in a moment that's being debited. What account is being credited by the charging of a fee? Well, if you said cash and bank, you'd be correct. Now, there usually isn't a specific account that's called something like bank service fees expense. There's not really a whole lot of use for that, because those fees are typically the same from month to month. And you'd be seeing that fee one time. So you'd be using an account for one transaction over the course of the month, and if you have a monthly accounting period, well, there you go. So the debit that we will use is the ever-popular miscellaneous expense account. There's your debit. We'll debit miscellaneous expense for $8. We'll credit cash and bank for $8. And here's the journal entry. You'll notice that on November the 1st, we have a debit to miscellaneous expense in the amount of $8 and a credit to cash and bank of $8. And the book has not listed a source document for this. We could just put in that this is the October bank statement, or something like the bank service fee for October of 2000 and whatever. Now, it is usually the case that checks get written, presented for payment, taken to the bank, forwarded to your bank, and taken out of your balance without any problem. Usually there's no incident, there's no trouble, there's no complications. Unfortunately, that's not always the case. And so there are some special banking procedures that we want to be aware of. First of which is what's called a stop payment order. A stop payment order is a demand by the drawer, that's you, that the bank not honor a specific check. You are asking your bank that when that check returns to you, if that check ever returns to the bank for payment, that the bank not pay it. Now, what might cause you to be justified in saying to your bank, when this check arrives, do not honor it? Well, obviously, you might say, well, I don't want to pay that bill. We'll pretend that it didn't happen. No, it doesn't work like that. There has to be a legitimate reason. And a lot of times that legitimate reason is the check got lost. We don't want this check to be found and then come back against you at a future time. So if the payee comes to you and says, we lost this check, we're not sure where it went, can you reissue it? You're going to say, okay, but I need to make a stop payment order on the first check. So if it resurfaces, don't do anything with it, just get rid of it. It might also be the case that some kind of a critical error was made on the check. The check arrives in the mail to the payee, and the payee realizes you wrote the check to the wrong business, or you wrote it for the wrong amount. And this may or may not be a fixable mistake on the part of the payee. They may just not want to do it. You may not want them to do it. In which case you say, nope, this check is done. We're over here. And so you would place a stop payment order. Now the catch is that the bank has to be given this order before the check gets presented for payment. If they have received this check, be it the physical check or the imaged check, it's too late. If they've already got the check, if they've already transferred the money to the payee's bank, it's too late. Game over. You have to put the stop payment order in before the check arrives back at your bank for payment. So how you would record this in your checkbook is you would go to the check stub of whatever check is being stopped, and you'll write stopped payment on that check stub to indicate to you that this check should never come back to you through the bank. And then, since that's money you thought you had spent that you hadn't actually spent, that's money that should be going back into your checking account balance. It goes back into the checkbook balance, it goes back into cash and bank, and as a result, you will need to add the amount of the stopped check onto the next unused check stub. And if it's appropriate to replace the check with a new one, you would go ahead and do that at that time. Here is visually what this looks like. Notice that we have written very clearly on the stopped check stub, stopped payment. This check should never ever reappear for us. At some point in the past, let's see, on January the 12th, we issued a check to Smith Engineering in the amount of $500, and for whatever reason we need to stop payment on that check, and we don't notice it until we're all the way ahead to check number 652. So we've made that stop payment order, and we go to stub 652, which is the next check stub in order. We have previously written 651. And in the area where we would record our deposits, we'll make a notation that we have stopped payment on check 633. Make sure that you note which check it is. This is money that's being added back into the account, so we'll take the $10,452 and we'll add $500. But I don't want you doing this addition, and you shouldn't be doing this addition to get to the $10,952 until you are about to actually write check 652. Because along the way there might have been another stopped payment. You might have made a deposit. There might have been some kind of a fee that you need to record. You might have other things that need to be listed in here. Don't go as far as totaling here until you're ready to write the check. Now, one thing to remember about a stop payment order that might give you some reason for concern is a stop payment order doesn't come for free. There's going to be some kind of fee that you are assessed. And just like the bank service charge, you would journalize that as a debit to miscellaneous expense. Another special case is what's called an NSF check. NSF stands for not sufficient funds. The drawer of the check did not have enough in the account to cover the amount of the check. For example, they wrote you a check for $500, but their checking account only had $400 in it. So you might be the recipient of an NSF check, but you do not ever, ever, ever want to be the issuer of one. Don't let this happen. This requires having accurate and up-to-date records in your checkbook of exactly what your balance should be. Now, you probably haven't heard the term NSF check used other than in this video. These are also referred to commonly as a dishonored check, or even more commonly, as a bounced check. So the idea of a check bouncing is the idea that it was presented for payment, and when the banks put their heads together, they realized the issuer of the check, the drawer of the check, did not have enough money to actually issue this check. And so the check is bounced back to you as the potential depositor or cashier of this check for you to figure out what you're going to do about it. So just as you would not want that to happen to you as the recipient of this bad check, you don't ever want to issue a bad check. So again, the process might work like this. Let's say that Burton Company has issued a check to Roadrunner. Roadrunner deposits that money in the bank. The bank adds the amount to Roadrunner's balance and then discovers when it goes off to collect its money from Burton's bank. It finds out, American National Bank finds out that Burton didn't have enough money. They didn't have sufficient funds. Burton's bank is dishonoring this check because there's not enough money there. So now what? Well, at this point, the bank would subtract the check account, the amount of the check amount, from Roadrunner's balance. Take it back out. It should not have gone in the first place, and back out it comes. The bank sends that check back to Roadrunner and says, yo, go figure this out. And by figure this out, it means Roadrunner now has to go contact Burton and say, what the heck? And since that money came out of Roadrunner's checking account on the bank, and it also needs to come out of the checkbook. And additionally, there's a journal entry to be made here, because this does actually count as a business transaction. It's the undoing of a previous transaction. So we'll subtract the amount of the check from the checkbook balance. I think by now you're probably familiar with how that would be noted and where that would be noted on the check stub. And as far as the journal entry, you would be creating or adding to an accounts receivable account for Burton by debiting accounts receivable Burton Company for the amount of the NSF check, and you would credit cash and bank because you are out the money that you thought that Burton had paid to you. Here's what the journal entry would look like. Again, we would post this in the normal way, but we're not doing that here in these slides. Just be aware that any journal entry needs to be posted to the ledger, including this particular case. One more special case to look at. It's a quick one. It's the idea of a post-dated check. And this is a check that is written, that is issued for some future date. Remember that in the top right corner of the check, there is a spot for the issuer of the check to put the date. It's supposed to be today's date, but some people will put a future date. And the catch here is that the business has to wait until that date. The business receiving the check, your business, has to wait until the date on the check in order to do anything with the check. Let's say, for example, that today was April the 4th. The check was written, it was dated April the 7th. That means that even though you might be in possession of the check on the 4th, and the person who gave you the check is probably in possession of their goods or has received the services, you can't do anything with that check until the 7th because the check is dated for the 7th. You are under no obligation to accept a post-dated check for payment. There is nothing that requires you to do that. You may be doing it as a courtesy to the customer. The customer may be saying, okay, here's my check. Please understand, I'm not going to have the money in the account for another 2 days. And I'm going to post-date it. You can accept it. There's nothing that says that you have to decline it. There's also nothing that says that you have to accept it. That's a decision on your part based on how much you want to keep your customer happy, or how much you want to keep your accountant happy. Finally, let's take a moment to talk about a legal action called the Check Clearing for the 21st Century Act. This came into effect in the year 2004. It's commonly referred to as Check 21. Check 21 allows for a paper check, a physical check, to be converted into the electronic image. So this is the law. This is the federal law that allows for you to get imaged checks with your bank statement, as opposed to receiving the canceled version of the physical check. And Check 21 allows for a conversion of the paper check to the electronic check. It makes the banking system go faster as far as processing. However, there's no requirement to process deposits any faster. So there is an increased risk of bouncing a check if you are not careful. All the more reason for you to be very, very careful and very meticulous with your record keeping. Part of Check 21 is the idea of electronic funds transfer, the allowance of banks to transfer funds electronically rather than through the exchange of checks, through the physical exchange of checks. This allows for money to flow a lot faster, and also reduces the risk of a transfer in an incorrect amount. You've eliminated the bank having to physically take your physical check and interpret what is written on it. We see electronic funds transfer in a lot of ways that we have become accustomed to. For example, direct deposit of an employee's pay. This is where the employer deposits the employee's net pay directly into their bank account. Automated bill paying, where the business is automatically drawing money out of your checking account. Now, you have authorized this, of course. They haven't just pulled your checking information out of nowhere. They are withdrawing money from your account automatically when the bill is due. Bank cards, such as debit cards, are an idea of electronic funds transfer. Telephone banking and online banking are also methods of conducting electronic funds transfer.